Hey, it's Mike at Cross Country Mortgage. It's Monday morning. It's the week of June the 23rd. It's time for your Monday morning mortgage update. I always try to give you insight on what's going to happen in the market this week related to real estate, the mortgage market, to give you some insight, some information, some tips, tactics, things that you can use when you're out there buying, selling a house, representing buyers and sellers. So let's talk about what happened last week, and let's talk about what happened this week. So last week, we actually saw a flat market. There was a little bit of improvement to pricing, which means a little bit of money flowed into that bond market, but it really didn't affect the rates that much. The big thing that happened last week, it was a short week because Thursday was a day off. And the Federal Reserve met last week. That was really the big news. And then some geopolitical stuff. But the Fed came out, didn't make any rate cuts. Nobody expected that. But they also came out with their economic projections. And what they do here is they say, what does it look for the next 6 months, 12 months? What's going to happen in 2026 with rates in the economy? And prior to this meeting, about a quarter to a third of the Federal Reserve members that vote on whether they're going to raise lower rates and set economic policy, they basically said, we're going to have some rate cuts in 2025. This meeting, half of them said no, and half of them said yes. So a shift in the perception or the insight of these Fed members that are basically saying, hey, we don't really see a rate cut coming in 2025. But again, half of them said two. So that basically didn't affect the market that much, but it gives us some idea of really what's going to happen. Now, keep in mind, when the Federal Reserve cuts their rates, their Fed fund rate, they're doing that to keep the economy stimulated. We always want a growing economy, but that Fed rate cut affects short-term rates, not long-term rates, which are mortgage rates. That's impacted by the trading of mortgage-backed securities in the bond market. When money flows into that bond market, those 30-year mortgage rates or those mortgage rates generally are affected. So when the Federal Reserve cuts rates, it affects home equity line rates, car loans, rates that they set on credit cards, the rates that banks give businesses when they borrow money. So it does have an indirect impact. Let's talk about what's going to happen this week. I'll give you three things that are going to move the market. Geopolitical, boy, that's been the top of the list for about a month now. Inflation, and then some Federal Reserve members and what they're saying, some important stuff that they said this morning. So geopolitical, two big things. The big, beautiful bill. The big, beautiful bill still hasn't been passed. And what is the big impact of this? A deficit. If it passes, there's going to be a larger deficit. If it doesn't pass, there's going to be a larger deficit. It really is the what's going to be worse. And theoretically, if it passes, it'll be less of a deficit. If it doesn't, it'll be a larger deficit. And that affects inflation. That really is the key here. We remove all the noise and everything that everybody's saying about whether it's good or bad. More deficit means more inflation, and that's not good for mortgage rates. The next thing, obviously, is the Israeli-Iran conflict. If you paid attention to the news, you know that we threw bombs in on Iran and got involved in some way. So typically when there is this kind of conflict, I talked about this in my rate drop on Friday, it's a flight to safety for most investors because they want to minimize the potential volatility in the stock market. So money typically moves over to the bond market, which is positive and friendly for mortgage rates because they're sitting their money in that safer place, less of a return, but a safer, more guaranteed return than the volatility of the stock market. Well, none of that happened over the weekend. It didn't happen. The market opened up today with really no significant change to pricing. And so basically the bond traders don't think that Iran's going to be able to do much. That's the general consensus. And so they're not moving their money in. Investors don't really think there's going to be much of a change. And we'll be watching this closely this week to see if there's more escalation, if there's more of a broader involvement with other countries. And it could shift. We could see that flight to safety. So if we see that money move into the bond market, then it'll be positive for mortgage rates. The second thing is inflation. PCE is coming out Friday, the Fed's key indicator of inflation. They pay a lot of attention to this report. We know the CPI and the PPI came out last week and didn't really, or the week before, and didn't really affect the market. What we do expect inflation to go up a little bit. The other thing about the geopolitical that could affect inflation is that this conflict is happening in the oil area, OPEC, and if this disrupts oil supplies globally, especially to us, oils and everything, petroleum and everything, that is inflationary. That could cause rates to go up. Will we see that impact today? No, that'll be a further thing down the road, but we may see some movement in the market depending on, again, whatever happens in this conflict. And the last thing is the Federal Reserve. So I talked beginning here that the Federal Reserve last week came out with the economic projections, and half the Federal Reserve said no rate cuts, other half said maybe two. Well, we know that the Federal Reserve chairman is Jerome Powell. He's in charge. Second in charge is a guy named Christopher Waller, excuse me. He's the governor of the Fed. And he came out today and said, hey, I think we should cut rates by July. We shouldn't wait for information and react to old information, because we all know the data that comes out is always 30 days or 60 days old. We need to be forward looking and not pay attention to what the tariffs may or may not do. We need to maybe cut rates in July. So really very different than the Federal Reserve chairman is promoting, where we just don't do anything until we get data. The governor is saying, hey, we need to cut rates in July. So it'll be interesting to see what the Federal Reserve members say this week, because there's going to be a lot of talking. And that really could move rates positive or negative, depending on the perception of everybody else. So we are floating. And I want to show you the market here. It's kind of interesting what's happened. If we look at the right here, you can see that we see solid green movements. That means money's been flowing into the bond market. We are up 7 basis points. We were up as much as 16 this morning. We were also negative starting out the day. And you can look at this blue graph here. This is where the market is moving right now, the bond market, where mortgage rates are determined, compared to Friday's movement. And so we're above this line of resistance. That's a big shift. That means that we're seeing positive rates, but then we duck right below it. Again, it was up double. Now it's down. It started negative. What are we looking at? What's that mean? It's just a ton of volatility. We're in a floating position right now, really watching the market this week. And if anything changes, we'll move to a locking position. So I hope you have a great week. And if you have any questions about your rate or the rates of your clients, don't hesitate to give me a call. If you want to be connected to my rate drop on Friday, I text this out. I need your permission to be able to put it in your inbox. Just shoot me an email, shoot me a text, let me know, and we'll get it sent to you Friday mornings. Have a great, productive week, and I'll talk to you soon. Bye.